These are the unluckiest retirees in American history, people who followed what should have been a safe retirement plan and still went broke. In 1966, if you retired with a $1 million portfolio and followed what we now call the 4% rule, you would have run out of money before reaching age 90, despite your investments averaging an impressive 9.5% annual return over 34 years. This is the story of how aerospace engineer William Bengen accidentally discovered the most dangerous retirement scenario in modern history, and why understanding what happened to the 1966 retiree could save your retirement today. William Bengen was not looking to revolutionize retirement planning when he sat down with his spreadsheet in the early 1990s. The MIT-educated aerospace engineer turned financial planner was simply trying to answer a question his baby boomer clients kept asking. They asked, "When I retire, how much can I spend?" At the time, there was virtually no expert guidance on safe withdrawal rates. So Bengen decided to investigate himself, armed with historical data and engineering precision. What he discovered in his 1994 study would become known as the 4% rule, the idea that retirees could safely withdraw 4% of their initial portfolio value in the first year of retirement, then adjust that amount for inflation each subsequent year. But here's what most people miss. Bengen's 4% wasn't a recommendation for optimal retirement spending. It was a warning about the worst-case scenario in American financial history. That worst case belonged to someone who retired in 1966. Picture this. You are 65 years old in early 1966. The economy is booming. The Dow Jones has more than doubled in the past decade, and on February 9th, it touches 1,000 points for the first time in history. Everything looks perfect for retirement. You have saved diligently, accumulated a substantial portfolio, and you are ready to enjoy the fruits of your labor. You had no way of knowing that February 9, 1966 was not the beginning of continued prosperity, it was the peak. What followed was a financial nightmare that would last nearly 2 decades. By the end of 1966, the S&P 500 had crashed 22%. The Dow would not sustainably break 1,000 again until November 1980, more than 14 years later. But the market crash was just the beginning of the 1966 retirees' troubles. Starting in 1965, what economists now call the Great Inflation began ravaging the American economy. Inflation, which had been a manageable 2% in the early 1960s, exploded to 6% by 1970. It reached devastating peaks of 12% in 1974 and an unthinkable 15% in early 1980. For a retiree on a fixed withdrawal plan, this was catastrophic. Here is why this created the sequence risk that became the perfect storm for retirement failure. When you retire, you face sequence of returns risk. It is not just about average returns over time, it is about when those returns happen. Early losses combined with ongoing withdrawals can permanently cripple a portfolio, even if markets recover later. The 1966 retiree experienced the worst sequence imaginable. Their portfolio got hammered immediately by the market crash, then continued bleeding value through the stagflation of the 1970s. From 1966 to 1982, stocks essentially went nowhere. The S&P 500 gained just 17% in nominal terms over that entire decade, far below the rate of inflation. In real purchasing power, stocks lost nearly 50% of their value during the 1970s. Bonds offered no refuge. From 1966, average real bond returns over the subsequent 5, 10, and 30 years were a pathetic 0.7%, 0.15%, and 3.1% respectively. When inflation is running at double digits and your bonds are earning single digits, you are losing money every single day. But here is the cruelest irony. Despite this horrific start, the 1966 retirees' overall returns were not actually bad. From 1966 to 2000, their portfolio averaged that impressive 9.5% annual return. The explosive bull market of the 1980s and the 1990s delivered spectacular gains. But it was too late. The damage from those early years was irreversible. This is the mathematics of retirement destruction. When you withdraw money every year to live on, early losses become locked in permanently. Even if your remaining portfolio doubles or triples later, you are working with a much smaller base. The money you withdrew during those lean early years is gone forever, along with all the compound growth it would have generated. William Bengen's analysis showed that a 1966 retiree with a 50-50 stock and bond allocation could have safely withdrawn just 4.15% initially, rounded down to 4%, to make their money last 30 years. Any more, and they would have gone broke before their natural lifespan ended. This finding was later confirmed by the famous Trinity study in 1998, conducted by 3 professors at Trinity University in Texas. They analyzed the same historical data and reached similar conclusions. The 4% rule stuck because it was based on the absolute worst retirement scenario in modern American history. But understanding the 1966 retiree teaches us something profound about retirement planning. The rule was never meant to be the optimal withdrawal rate. It was designed to survive the financial equivalent of a perfect storm. Bengen himself has said that people who follow strict 4% withdrawals are probably cheating themselves out of retirement enjoyment. In fact, when you look at all historical retirement scenarios, the average safe withdrawal rate was actually around 7%. Some retirees could have safely withdrawn 10%, 12%, even 13% initially. The 1966 retiree just drew the shortest straw possible. Today, the lessons from 1966 are more relevant than ever. We're seeing some eerily familiar warning signs: high market valuations, concerns about inflation, and geopolitical tensions. Federal Reserve Chairman Jerome Powell has warned that large tariffs could create conditions where both inflation and unemployment rise simultaneously, the exact definition of stagflation that destroyed the 1966 retiree. Modern research reflects this uncertainty. Morningstar's 2024 analysis, led by Director of Personal Finance Christine Benz, suggests new retirees should consider starting withdrawal rates of just 3.7%, even lower than Bengen's original 4%. Higher stock valuations and lower bond yields have created conditions that echo some of the challenges faced by that doomed 1966 retiree. Yet Bengen himself has evolved beyond his original rule. In 2025, at age 77, he suggests that most current retirees can safely withdraw 5.25% to 5.5% initially, using the Shiller-Cape ratio to assess market valuations. His latest calculations show that 4.7% would have been his universal safe maximum for any historical scenario. The key insight: flexibility matters more than rigid rules. The 1966 retiree's fate wasn't sealed by bad luck alone, it was sealed by inflexibility. They followed a fixed withdrawal strategy into the teeth of an economic hurricane. Today's retirees have better tools, dynamic withdrawal strategies that adjust based on market conditions, more diversified investment options, including target date funds, and crucially, the knowledge of what can go wrong. Some financial advisors now recommend guardrail strategies developed by researchers like Jonathan Guyton and William Klinger that involve withdrawing more when markets are up and less when they are down. Others suggest keeping several years of expenses in cash to avoid selling stocks during market downturns. Modern retirees also benefit from Social Security as a retirement income floor, providing inflation-adjusted payments that were not available to 19th century retirees. These approaches could have saved the 1966 retiree, even with the same brutal market conditions. Interestingly, these lessons have resonated beyond traditional retirees. The FIRE movement, Financial Independence Retire Early, has embraced modified versions of these withdrawal strategies, though often with more conservative rates for their longer retirement horizons. The story of the 1966 retiree serves as both warning and inspiration. Warning, because it shows how sequence of returns risk can destroy even well-funded retirements. Inspiration, because it represents literally the worst-case scenario, and even they lasted decades with careful management. William Bengen, the aerospace engineer who discovered this scenario, never intended to create a rigid rule. He was solving an engineering problem. What is the minimum safe withdrawal rate that survives even the worst conditions? The answer, 4%, became gospel for millions of retirees. It was always meant to be a floor, not a ceiling. Today, as new retirees face their own uncertain future, the 1966 Retirees Experience offers crucial guidance. Plan for the worst, hope for the best, but above all, stay flexible. The person who retired into the perfect storm of 1966 could not change their timing, but you can learn from their experience and build a more resilient retirement strategy. The 4% rule did not fail the 1966 retiree, it saved them from complete disaster. Understanding that distinction might just save your retirement too.